So if you have a 401k and let's say it's worth $500,000, would you know that one simple rollover mistake could cost you anywhere from $100,000 to $150,000? So I think it's really important that you understand how to roll over your 401k. And people make mistakes every single day when it comes to rolling over their retirement accounts. And we're going to talk about that in this educational video today, because we don't want you to do the same. Hi, my name is Carson Graves, President and CEO of the Retirement Education Center.
And my name is Andrea, Director of Operations at the Retirement Education Center. And the reason that we're making these educational videos is to help make the difficult and stressful process of retirement income planning simple.
Absolutely, and we do this, of course, by providing our clients with a fully written retirement plan that's going to let them know when, where, and how to take money from their retirement savings.
For the best retirement income advice, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos.
So a 401k rollover mistake could lead you to paying higher taxes on your entire balance. And let me show you how. No matter if you take out $1 or $1 million from your 401k, the IRS is going to consider that as ordinary income. And if that pushes you into a new tax bracket, you're going to have to pay taxes in that new tax bracket, and that can be very painful. But we don't want that to happen to you today. So we want you to watch this short educational video and learn about how to avoid some of the common mistakes that's made by millions of people every single year when it comes to rolling over their retirement accounts. But before we share our screen with you and talk about this, there are two rules to retirement income that we always want to share with you. What are those two rules, Andrea?
Well, rule number 1 is to never run out of money, and rule number 2 is to never forget rule number 1.
So let's talk about some of the common mistakes that are made when it comes to rolling over your 401k. So when you're looking at rolling over your 401k into an IRA, you really typically only have two choices, a direct rollover or an indirect rollover. With an indirect rollover, you actually take possession of the money from your 401k, and you are responsible for putting that money back into another 401k or another retirement account. But when you take possession of that money, you're going to be subjected to what is known as a 60-day rule. What this rule states is that if you do not have this money from your 401k put back into another retirement account within 60 days, the IRS is going to consider it a full distribution. And you're going to have to pay income taxes on that money at the ordinary income tax rate. Plus, if you're under the age of 59 and a half, you will also be subjected to a 10% early withdrawal penalty from that account. Another thing to consider with a 60-day rule is that you can only do one from any retirement account in any given 12-month period. So you can't do multiple indirect rollovers. You have to wait in order to do another rollover from an IRA, which is also an inconvenience. Plus, your former employer is required typically to withhold 20% of the money from that indirect rollover for future taxes, just in case you don't actually complete that rollover. But let's say you do, you follow the rules, you complete the rollover, then you will get that 20% back, but not like you think. I want to show you a quick example here. Let's say you have $200,000 in a 401k and you're going to do an indirect rollover. So your company is going to withhold 20% for taxes, leaving you with $160,000 to put back into another 401k or an IRA within 60 days. What about the other $40,000? What's going to happen there? How are you going to get that full $200,000 into the new retirement account? You have to pay it out of your own pockets. You have to actually find that $40,000 and put it into that retirement account to make up the difference. If not, you would then be subjected to taxes on that $40,000. And if you're under the age of 59 and a half, you will also be penalized with the early withdrawal penalty. So of course, there is a better way to do this, and that is with a direct rollover. This would be known as a trustee to trustee rollover. So your 401k would then go directly to the bank or financial institution that set up your other IRA. So you might also be mailed a check, but that check is going to look like this: SYZ Financial, for the benefit of Mr. John Jones IRA. Even though you received a check, it's not made directly out to you, so this is still considered a direct rollover, still allowing you to pay no taxes and also allowing you to avoid the 60-day rollover rule. So again, I hope this was very helpful in helping you understand how to avoid some major mistakes when rolling over your 401k into an IRA. Please make any comments or questions in the comment section below, and don't forget to subscribe to our channel.
Again, if you have questions or comments regarding this video, please leave them in the comment section below. After this video, check out the other videos we created to help you maximize your retirement income. To learn more about our services and how we can increase your chances of not outliving your retirement savings, click on the link in the description below. Also, if you like this video, give it a thumbs up, subscribe to our YouTube channel, and share with a friend. Thanks for watching, and remember, if you have questions,
we have answers.